Good afternoon, everybody. It's Doc here from OnTheMoneyOptions.com, and I saw an interesting setup today that I thought would make a great example of knowing when to hold off putting a trade on. We're looking at a chart of Edwards Lifesciences. I have three time frames on here. The far left is the monthly, the middle is the weekly, and the right is the daily. I do all my trend analysis on the monthly and weekly charts, and you'll notice that Edwards Lifesciences has been moving up. Very high probability trade of going into a stock when it breaks out to an all-time new high. And Edwards Lifesciences did this recently. I typically wait to make the trade to give it time to come back and check the breakout level, which is exactly what this one has done. So I'm looking at putting a trade on. Now let me explain why I'm interested in Edwards Lifesciences. I've done a relative strength analysis comparing Edwards Lifesciences to the healthcare sector and the healthcare sector to the S&P. As you can see, in the last month, the S&P has been up. The healthcare sector has been up much more than S&P, and Edwards Lifesciences is up almost 12%. So it's outperforming the healthcare sector, which is outperforming the S&P. This makes it a stock that I'm interested in. So in these situations, I began to watch the option activity to try to understand what the big boys are thinking about it and when is an appropriate time to enter. Today, a trade caught my attention. At first, I thought it was different than it really was, so I want to show you this. If you look at the 175 strike, you'll see that there are 5,000 contracts, a little over 5,000 contracts there. When I looked at the time and sales, I realized they were at near the ask. So that means that someone was buying them pretty much at full price. Now that would make you think that they're pretty bullish. They're expecting it to go above 175 and to go further above 175 than the cost that it took them to get in the trade. On a little further investigation, you'll notice down here there's a large volume at the 160 level. So I dug in and looked at that a little bit, and I realized that these are 160 calls that are sold. So they match about 2-to-1 to that 175 up there, and that would indicate that we're looking at a ratio spread. So what you see here is that someone sold 2,950 EWOC 60 calls at $3.30. Then they turned around and bought twice as many of the EWOC 75 calls at 70 cents each. This sets up the ratio spread. This is a credit. So what you see is that for each spread, they bought in $3.30 and paid out $1.40. So what we're looking at here, this is a trade on 295,000 shares of stock. You've got a $15 spread between 160 and 175, and it got paid $1.90. So when you analyze this, you realize that this is not a bullish bet. This is a bearish bet. This is betting basically that the stock will be under $160 a share by the October expiration in 16 days. So because of that, it makes sense to hold off a few more days and watch and see what happens before we put a position on. Obviously, we can always run into a situation where we just look somewhere else. Anyway, this is a good example of being able to look inside the option contracts to try to understand what the intent is of the big institutional traders before you make a trade. This can probably save your bacon on a few occasions. So anyway, I hope this helps. Until next time, this is Doc saying so long and stay hedged.